All right. We're getting everybody in. Happy Friday, everybody. It's so good to see you guys. I see Ira, David. Oh, they're coming in so fast. I can't get to everybody. Jennifer, Kevin, Lisa. Hey, Lisa. Natalie. Oh my gosh, Natalie, it's been a little while. I get to see her in Denver. All right, in just a few weeks. Oh gosh, I get to see so many of you in Denver in a few weeks. All right, happy Friday, everybody. We're super excited that you have joined us today. Rob apparently is eye candy today. He's got the ability of speaking to us, but he cannot hear us. So we're gonna do some fun things and put some questions to him in the chat to try to help him to know when to talk and speak and those sort of things. But no, it's gonna be a little bit of a different experience today. So, all right, I am sending him over a question to ask where he's at today so that he can help us to see a little bit more behind him. Maybe. We're going to see if this is going to work. Nope. All right. All right. We're just going to roll with it. Rob is going to be our eye candy today. All right, so I do have a couple of quick trivia questions as we get everybody in. It normally takes a couple minutes to get folks in.
You can hear us?
I can hear you.
You can hear us now. Yay. All right, so I already told everybody you were just going to be eye candy today. So now we get an opportunity to actually hear your voice.
Now I can show everybody where I am.
Yeah.
All right.
Tell us where you're at.
All right. Well, I am in Reno, Nevada at hot August nights. And you can see some of the
classic cars.
Yeah. It's quite the spectacle.
Femi is asking if those cars are California emissions compliant.
I can guarantee you there's not an electric vehicle in sight.
Okay. All right. That's fantastic.
So I will say occasionally a loud engine will go by, in which case I'll mute this, but I'm glad I got the sound working.
I am glad you got it working too. I love it. Scott says now you're eye and voice candy. All right, well, we're going to go ahead and get kicked off, and I'll introduce our special guest today. But first, if we have not met before, my name is Melissa Langdale, and I'm the president and COO of the Mortgage Collaborative. As always, joined by Rob Chrisman. And this week's special guests with us are Jennifer Murphy and Don Nash, who are VPs of the Homeownership Council of America. So we have lots of fun things planned for discussions for them. But before we get into that, Jennifer and Don, thank you guys for joining us today.
Thank you.
Thanks for having us. I'm excited.
Yes, thank you.
I'm so excited. I've got a couple of trivia questions for us to get kicked off, which are super relevant to your space. So you can answer them if you know, but we can also pause a little bit and let the audience chime in the chat. So audience, get ready. The first question is, what was the first year that SPCP, Special Purpose Credit Programs, were available? We know.
Is that for Jennifer and I?
Yeah, anybody.
I'd say 1974.
Yeah, 1974.
Did I answer too quick?
No. Oh, Rob, what do you think? I think he's still messing with his ears. We must have lost them. Yeah, there's actually two. I've seen two dates on this. Natalie puts in 1998. We've got a few 74, 76. I've seen both 74 and 76, so it's really interesting. But what was the, it was actually, I guess, put into place by ACOA, right, Jennifer and Don?
Yep.
Yes.
And then this
ACOA was passed as the year SPCPs were codified.
Codified, okay. All right, so 1974 it is then. We've solved all the problems. And then the second trivia question is, what is the current home ownership gap between white versus non-white Americans? As close as we can.
What was the question, Melissa? What is the,
The
Gap?
current home ownership gap between white versus non-white Americans.
I'm deferring to Jennifer with this because she's the data guru.
Well, I don't know the exact number, but it's around 30%.
Okay.
I was gonna
30
say
40.
20.
Now it's higher than that. Some places it's as high as 45%.
For sure.
Yeah, I think it's totally, oh, look at all these answers. I think it's totally market driven. Patrick, 70%. 70% is the like general home ownership rate, Patrick. So you're spot on there. The gap between the basically the home ownership rate for white Americans versus non-white Americans is about the last data point I have says 28%. But it's totally going to vary by market, right? So in some cases it might be as high, like Jennifer said, at 45%. And in others, it may be maybe less, but that's like a national average. And that was based on Q1 of this year
Then it's
data.
gone down, so that's good.
Yeah, a little bit of impact, maybe with some help from folks like yourself.
It was holding steady around the 30s.
Yeah.
Actually has gone up in the past 15 years. So it's nice to see it going down a little bit.
Good.
For sure.
Well, for those that don't know much about Homeownership Council of America, can you guys share a little bit of a brief overview of who you are and what you do?
Sure. You.
That's on me, right, Jennifer?
You go.
So we are Homeownership Council of America, also known as HCA in the marketplace as well. We are a 501c3 nonprofit social enterprise, and we're driven by our mission, which is to bring equitable credit to America's historically underserved communities. We have a suite of programs, services, and products that we offer that we've developed that we believe solves for the problem of closing that gap. Because we've seen it increase over the years. And with all of the progress that America has made, we've seen that gap increase. And I think Jennifer and I would like to think we have something to do with it decreasing over the last 2 years with the reemergence of the SPCP program. So we provide support services to financial institutions, CDFIs, community banks, investment mortgage bankers to allow them to either through technical assistance or capacity building and to develop systems of operation that allow them to have a little bit more bang, especially in a climate when the mortgage industry is taking a hit. So our customers are banks, CDFIs, and nonprofit organizations.
I love it.
I'd like to know how I'm asked all the time, Rob, how did you get into mortgage banking? So I tell them my little tale, but how did you get into, it's almost a derivative of residential lending. How did you even hear about this to end up with a career in this?
I have to say my career was totally accidental. So there was absolutely no planning at all in it. It wasn't like I went to college for it or said, when I grow up, I want to do mortgages. I don't know if anybody says that. But I have always wanted to help people. So I've worked mostly in nonprofit throughout my career. I've had one for-profit job for a community development bank where I worked in CRA. So my background was very heavily CRA, Community Reinvestment Act lending. When I met Gabe, who was our CEO, we were kind of unicorns in that we were both nonprofit people with a deep understanding of the mortgage industry. And I don't think there's a lot of us in the nonprofit world. But anyway, we met and we were like-minded, and he had started HCA a few years after that and asked me to join. We were doing mostly work with nonprofits at the time for nonprofits to become mortgage brokers, CDFIs especially to become mortgage brokers. And the SPCPs started to become a hot topic. And I think it's a natural progression from CRA to SPCP. There's a Venn overlap between the two of them. So we really didn't have much to go on, right? We had four bullet points in the CFPB said this is what you need to do. We took that and we made it into a program, which is what nonprofits do. and created a curriculum for it and started working with lenders so that they could go through the process of developing the SPCPs. And also we wrote the written plans for them because most of them don't have a person on staff who is a writer. And I just happen to have had a lot of grant writing and writing experience as well. One thing about working in a nonprofit is you wear a lot of hats.
Mhm.
So,
I think we can all understand that.
yeah, so there was a gap there, and you know, it fit our mission. So we worked really hard to come up with a curriculum and a process, and I think we're now, I think we're on our 27th SPCP in the past 2 years. So we've done quite a lot of SPCPs.
Fantastic. A lot of folks think that you have to be a bank or a depository, like a credit union or a bank. You've got to have the ability of holding your own portfolio in order to offer an SPCP. Is that accurate? Can you clear the air for us?
No, so the vast majority of our customers have been independent mortgage banks, IMBs. Fannie and Freddie both have pilots that use loan level price adjustments to help to build a down payment program and allow you to use their affordable mortgage product at a higher income limit for people of color. So that's there, but they also, if you develop your own SPCP, they will purchase them. We work very hard with our IMBs to make sure that everything we do fits the Fannie Freddie guidelines so that they're saleable. And a lot of them are being sold also for CRA credit if they fit into that bucket as well.
And you guys actually have a certification that you allow for lenders to go through too, called, I think it's called Equity Certified Program. Is that right?
Yes, yes.
Tell us a little bit about how you're leveraging that to help your lenders.
Well, that's a really good question, and I'm really passionate about it as well. So it's kind of my baby. I have an oversight for that equity certification program because of all the work that we're doing in the space of SPCPs, helping develop programs we're creating programs because Jennifer does a lot of that writing, as well as going and helping modify programs that are currently existing. What we found is that there's a gap that exists between the financial lending institution and the consumer. Right? Because America has kind of a prickly past, and we all know how we got here, we have these underserved populations. And so somewhere along the line, we've got to support the financial institutions to learn how to speak into the listening of the target audience that they're actually trying to reach out to. On the flip side of that, you've got the consumer that we now need to move closer to trusting the lending practice and programs. So many financial institutions build an SPCP or attempt to build something like an SPCP in hopes to reaching that market, but they've learned that just because you build it doesn't mean they'll come, right? And so what we've done is we've brought the marketing curriculum in, so how to effectively take it to market. And then we developed the equity certification program. So we like to think that this equity certification mark, it is a trademark that could be utilized for as SPCP offered by a financial institution, CDFI, or nonprofit organization that resides so that the consumer will look for the equity certified program. So an equity certification is only issued to an SPCP program. We are building a database right now that houses all of the SPCP programs that are offered nationwide so that we could bring the consumer and the lending institution together. So we're solving for that problem because there is what we know is a trust gap, right? And if we're able to close that trust gap, then we're bringing consumers to lenders that are offering products. We're helping the lenders learn how to more effectively render that product in the marketplace. And there's where the magic of homeownership takes place. And that's when the gap begins to close. Equity certified.
What is driving
So-
that? Oh, go ahead.
Oh. Go ahead, Melissa. Sorry.
I was just going to ask, what do you think is driving, or what are some of the things that you suggest to help bring that consumer and lender together when there is kind of that, either that lack of knowledge or trust in the marketplace with financial institutions? How are you helping them to bridge that gap?
We have a multi-pronged approach, right? So
Right.
one of the things is that we are a nonprofit organization, and we have deep ties to our fellow nonprofit organizations. So by We try to connect the nonprofits to the lenders because they have the ear of the customers. A lot of them are working directly with customers, trying to get them mortgage ready. And if they know about SPCPs and who has SPCPs, it's a lot easier for the consumer then to take advantage of the product. The other thing we do is, I think that this is unique to those amongst those that offer SPCP planning, is we have a whole 2-hour session where we talk about marketing, and we discuss talking about race. We discuss encouraging people to check off the boxes on the HMDA data. It's really getting people to be comfortable having a discussion with other people. And then the other thing is to use, in advertising, use photos and imagery that people can relate to and engage to and say, hey, they've got loans for me. That's really what it comes down to. Right now, most SPCPs are place-based. They're in majority minority census tracts. But more and more, we're having people come along and sign up and do people-based program, where if you check a box on HMDA, that is one of the categories that you would be eligible. That is, and then Don's work with Equity Certified takes over so that consumers will soon be able to go online and look for an SPCP. Right now, we don't know how many are out there either.
Right.
We actually have a question in our chat too. It says, how can one get assistance on getting started or creating an SPCP as an IMB? Everything I've heard is long and painful process.
Oh, wow.
Well, we try to make it fun. I'm a great believer that work should be fun and totally not painful. It's not probably as complicated as you might think it is. I think the thing that really stops people is the data collection and the writing of the report, but we do that for you. And what's important to note too, I think, is that we don't use your data. We use market data, because it's the market that has the problem. We're not looking to shine a light on any issues that you may be having, and we don't have to. So we do that. And if you're interested in finding out more, you can contact me, Jennifer, at homeownershipcouncil.org, and I'll be happy to sit down, set up a Zoom with you and talk to you about what our process is and how we do it. But it's, 4 sessions. We help you develop the product, put it to paper, get it ready, make introductions if you need them.
Oh, we've got another question from Brian. He says, I'd like to ask the HCA folks, what role do credit scores play in driving the homeownership gap? Put another way, could we narrow the gap for folks who can afford a home by using credit scores only as a gauge to determine who needs more help, guardrails to make sure the mortgage payment is prioritized rather than an eligibility or pricing determinant?
Well, if you are lending your own money, we can do just about anything, right? So portfolioing loans, we can do just about anything. We can leave that GSE credit box and we can discuss it. Sure, I've done really outside the box things, and I'm always I'm very weird in that I love making mortgage products, and I'm always looking for ways that we can help people reach home ownership, and sometimes credit scores are not reflective of actual credit history. There's been shown, we could do a whole series on the bias of credit scoring. But what we're finding is that we don't always have to address credit score. If we do, if we just allow 620 to really be the floor, rather than, it says it's 620, but we're not going to accept that. If we can actually let 620 be the floor, our work with our housing counseling partners can usually get people up to a 620.
I think it's also one of the tremendous benefits of working with us at HCA and the work that Jennifer does with the data and leaning into the market data and what does it say. It helps clear up the misconception that helping an underserved community means a loan is a greater risk, that the credit score is lower than what should be. And what we find over and over again is that's not the case. we have other factors that are actually keeping that gap wide open. And so we talk to lenders all the time and help them dispel the idea that this is a more risky loan, right? And so sometimes we have to look in. Part of our marketing is to have organizations look within to see where are those areas where we have been preconditioned to believe a certain thing about a protective class, or a particular population or geographical area. So those are very sometimes uncomfortable conversations, but we like to think that we know how to have those in a very delicate and warm, non-threatening way.
Yeah, the number one reason for denial across the board has been debt to income.
Yeah.
That's, credit scores are usually, they're in the top 5, but it's usually debt to income.
It's interesting.
And that we help with down payment assistance or by raising our ratios. A lot of times we go with 140% ratio.
To build on the credit score bias, I don't know if y'all are totally uncomfortable living in that space, but I think there's the challenge that a lot of renters have is not all landlords, right, report to the credit bureau. So they have this history of payment on something that is pretty indicative of how they're going to pay for their mortgage down the road, but there's not consistent history and consumers receiving that data today. Now it's starting to get a lot better. So maybe that's helping some of the homeownership gap that, is in front of us today. But I'd love to hear your thoughts on if you're seeing that, actually, I'll rephrase this. Are you seeing that any of your SPCPs that you're creating are allowing for maybe landlord history in order to kind of bridge the gap that we've been talking about? Is there more of a push to try to create landlord history as a part of their underwriting process?
For most of our lenders, what they put into their guidelines is that if a loan is denied, they'll give it a second look. And in that second look, they'll accept alternative credit histories. So that's something that is it's an easy fix. If you can't get through automatic underwriting, we'll have a live look at it and we'll try it, which we're trying to get to yes. That's really what we're trying to do. We're trying to get to yes. And another thing is that a lot of our lenders will use alternative down payment sources like Susus and Kais, where people keep their money within their community. A lot of Muslims do this. A lot of people from the West Indies do it. They keep their money within the community rather than in a bank. And it's usually run by someone and they'll write the letter that that's the source of the down payment. And that most lenders, it's been very common in the New York metro area, but we're seeing more and more lenders throughout the country say, yeah, that's a good idea too, right? Like let's be culturally aware. And I think that's a lot of what SPCPs are, is kind of meeting the borrower where they actually live, right, and realizing that the way that they're saving money or the way that they're using credit may not be, the cultural norm of the majority, but it's no less valid.
And I think what Jennifer just painted out there is a very clear picture that extends an invitation for lenders that are serving a particular market area that may know about some of these cultural pockets that exist, but not necessarily know how to create a program that extends an opportunity. And so working with us, we get a chance to explore that from that data. Oftentimes we have lenders say, I didn't know that. I would have thought the dynamic was this, because that's a very casual observation of it. But when you look at the data, it tells a different story. And what we love to find is that we're not only saying we want to help you do what you're already doing, we want to make sure we assist you in tapping into those borrowers that would never walk through your door, that would never go to your website and never apply with you because you're not marketing to them, and possibly because you don't know they're there.
I also am curious, as you're walking into, or working with community banks and credit unions, and they're walking through this road of creating an SPCP for the first time. How do you help them to navigate big questions like default risk and, what's the payoff time of these normally? Like there's no other data in the marketplace for something that's very unique. And so I just would love to hear how you guys are helping them to navigate that.
Well, we are pioneers in a way. Although the loans have been technically available for 50 years. And I always tell people I did my first SPCP loan with a woman who was buying a beauty parlor in Asbury Park, New Jersey in 1994. And it was the African American Chamber of Commerce who clued me in that there were small business loans available for women and minorities. They called them swim loans at the time. But we really didn't get any clarity until about 2 years ago from CFPB. When CFPB came out with their opinion, then all the other regulatory agencies jumped on and came out with similar opinions. So what it comes down to is that we have not been able to collect the outcome yet. We have conversations though with the lenders. I think we're, like I said, we're getting close to 30 that we've done so far. No one has come back. Every SPCP is a pilot. It's set up as a pilot, so you can change it during that year that you're rolling it out. No one's ever come back and said, let's stop this. No one's come back and said, let's make this smaller. When they do come back, they make it larger. They expand into other geographies. They add more down payment assistance. They do things like that. But no one has ever said, whoa, this isn't working, because these are paper loans, right? They are saleable loans, and we're not doing anything hugely outside of the standard credit box that's going to make them more high risk. And there's no studies out there and that have ever shown that LMI borrowers or BIPOC borrowers default at a higher rate than non-BIPOC or higher LMI, above LMI, I guess HMI. HMI borrowers. So they're actually very good loans. I don't see a losing proposition here, and I am risk averse when it comes to lending, because I worked in foreclosure. I worked through the foreclosure crisis, and I saw a lot of people that got loans that shouldn't have. And we don't want that. We want people to build wealth. We want to level out the playing field. We want people to own their own homes, build wealth, build equity, and be able to pass on that wealth to their children.
And I think as our CEO always likes to say, we prefer to use a carrot and not a stick when folks come and talk about the default rate of this thing, because I think it speaks to an internal bias, right? That assumes that the loan is more risky. And so that's why the work that we do with some of the lenders that we work with are having them turn in. Let's find out about who's answering the phone, who's sitting at the desk, who the processor is, who the underwriter is, who's making the decision, who's the first point of contact. Because these are filters, or these are gateways that bias can either be implemented. How many times we talk to loan offers that would say, no, I didn't make them another offer, or I wasn't sure. So, we didn't make that loan, and the borrower walks away. There's a home ownership opportunity that walks away simply because we don't recognize that we have things inside or internally in our organizations that we just need to address. And so we like to support the loan officers. We like to support the underwriters and everyone that's a part of the life or the operational life of a loan actually taking place. And we have to have those conversations that even I come from a historically underserved community. And yet I oftentimes admit to some folks that I filled out the application and I wanted to tick the box other, right? Because my historical narrative was that it would be more difficult for me than my counterpart to do that, right? So what do you say to me? What do you say to the loan officer that meets a me, right? That doesn't want to say, well, Mr. Nash, we actually have a program, depending on how you classify, that may be able to assist you. Would you think again about ticking this box? Or, so we want to have those conversations and be very candid about them, because they're real. And especially in the climate that we're in this, DEI resistant climate, right? And, this whole equality or equitable lending climate has become intense, and many lenders are reluctant to go in there because of that reason. And they oftentimes use the risk card, the default card, as being the justification for not doing it. But once we let Jennifer at them with all of her data, it's a different game.
I think it's important to note that everyone has bias, and it's okay as long as you check your bias, right? Like, right. And say to yourself, well, where did this even come from, right? And that's why I say there's been I can remember studies going back to, you know, the Federal Reserve of Philadelphia did a study in like 1996 that showed actually default rates were lower. Because a lot of people are looking at this, that it's their home. It's not an investment for them. It's an investment you can live in, is what I always used to tell people in my home buyer education classes. Where else can you live in your investment? I can't curl up at night with my Merrill Lynch retirement account, you know. But you know, this is, you know, it means something to people. It's not an investment for them.
All right, and I know we're really close to time, and Rob, you had your hand raised, so I want to make sure you get our last question today.
Well, it's actually quiet, relatively quiet here. I just wanted to say that whenever I go to conferences, there's always an exhibitor, whether it's you or a state level organization, that I think in the exhibition hall, the exhibition booth, is relatively lightly attended. And I always make a point of talking to the folks there, because they have so much to offer. There's so many programs that originators don't know about and that lenders don't know about. And once again, in this kind of environment where every borrower is precious, to be able to learn about these things, I think is very important. And I'm going to close with, going out in the sun now. A real quick little tour. Here's a
Nice cars.
Yeah.
There's a purple car over there, and there's a black car, and that's the extent of my car knowledge right there.
All right, so we got a tour of the classic car show.
I do think, Rob, you make a very good point. If I can just say that, one of the things is these are going to be loyal customers, and they're going to tell their friends. It's not, you're not getting just one customer. When you give someone a hand up, they appreciate it, and they tell people that you know, that their friends, their family, and the word gets around. And it won't be long before it increases your customer base. And money is money.
Absolutely.
Rob, we have one question for you from Steve. He wants to know if that's the same Woody that you drove in high school.
My first car was a '66 Mustang. There's some
Nice.
Mustangs, they're in a whole nother lot. I don't know. We have a loan officer here who's taking an application
Oh,
in the
that's
back of his
perfect.
truck, right there, working remotely.
Taking every advantage. I love it. All right, guys. Well, we are all up at time, and I want to be conscious of that for everybody. Jennifer and Don, thank you so much for spending some time with us. Cannot wait to see you guys in Denver. I know that we've got another one of these rundowns that you guys are going to be joining us on later on this year, as well as we continue to build on some of the opportunities for special purpose credit programs. So if y'all want to stick around or just pay attention to the rundown, we'll have another show around this later on this year and build on it. But I hope everybody has a fantastic weekend, and we'll see you again here next week.
Thank you.
Bye, everybody.
Have a great
Thanks, you
weekend.
guys. Bye.